Alright, good evening ladies and gents, welcome back to Compound Interesting. In today's video we're going to be discussing why index fund investing is completely broken and will make you no real returns over the next 20 years, and what exactly to do instead of index fund investing to actually make serious returns over the next 10 to 20 years or whenever the next bull market finally comes back. And sorry it's been a couple of days since I posted a video. As you can probably hear in my voice, I had very severe man flu, so I will be expecting some get well soon cards coming in the post. Well, maybe not my real address, you can send it to my Ethereum address, some digital postcards, that would be great. compoundinteresting.eth. But anyway, thanks for your sympathy. Let's get straight into it. Right, so the inspiration for this video was a video by Benjamin Cowan, and he has plotted the S&P 500 over the last 20 years versus the M1 money supply, or the M2 money supply. So basically the amount of dollars in the system, like physically circulating, and also in bank deposit accounts and CDs and stuff like that. So basically the amount of money in the world has increased massively over the last 20 years, and if you plot the S&P 500 over that, you get something very, very interesting. And as you can see, the S&P 500 hasn't really done anything over the last, since the dot-com bubble. So when it actually did crazy returns in the dot-com bubble, you can see there was a massive bull run, and then from the peak of the dot-com bubble, if we're charted against the M2 money supply, we're down 50%. So you've made no real returns when comparing to the M2 money supplies, the amount of dollars in the world. Now this is great if you just want to protect your wealth, have a store of value that you probably won't lose a huge amount of value over time. The S&P 500 is great. But if you're just looking to hold your value, if you're not looking to make any real returns, get the hell off this channel, because that's not what we do here. We want to actually make some serious gains. We're real investors on this channel. That's what I want to do personally. No, I'm just joking. You can stay on if you want to just protect your wealth. You might learn something anyway. So in my last video I kind of discussed the S&P 500 inflation adjusted. I brought that chart up, and it's not as severe as this one. Like, you still made some gains over the last 20 years when using inflation adjusted numbers, but the inflation adjusted numbers, that's just like the inflation rate is just kind of a made up number by the government. It's not really I think the M2 money supply is a much more, it's something you can't fudge up. It's not a made up number. The M2 money supply is just the amount of money in the system, and if you're increasing one side of the axis, obviously the other side of the axis has to increase as well. And not to mention, like, for example, if you invested in the S&P 500 from, like, just DCA'd into the S&P 500 from, let's say, 2000 to 2010 and got a nice average price, you're going to be up in nominal terms, but in real terms you haven't made any gains. But you're up in nominal terms, so you're actually going to be taxed. So you're actually down. You have to be taxed if you sell if you sell the S&P 500 stocks. So even though the sensible thing, and every financial advisor will tell you, just, DCA the S&P 500, you'll do great over time, you'll get an average return of 8%, but then the money supply just increases by 8%, and everything's price increases by 8%, so you haven't made any real gains. That's kind of what we're getting at here. So to actually make some real gains, you kind of need to be making 15 to 20%, 25% plus in real nominal terms over the next 10 years to actually make money in the stock market or in the crypto markets. The other way you could obviously make some returns, and it's not the way I suggest, but is to actually try and time the market. So you could have been investing in the recession, so in the massive drop after the 2000 dot-com bust, or during the 2009 crash. If you invested heavily in those times, you would have made a much better return than the majority of people. However, just so you're aware, we're in a recession now, so it's probably not the absolute worst time to start investing. Even if we're only halfway through this crash, still it's not the worst time, although we could obviously drop further. But whether you're halfway through a crash or halfway out of a crash at the very bottom, who knows? But any area within those times is probably a good time to be doubling down in your investments. And obviously the worst times is at major euphoric moments like 1 or 2 years ago. So one of the first times, or one of the very few times in history where governments have stopped printing money and have actually started to try and reduce the money printing, so taking dollars out of the system, is happening right now. So everything's going to crap. The economy's not looking great. We're in a potential war, World War III, whatever. So yeah, everything doesn't look great from a macro outlook, but you can look at this as a complete disaster, or you can look at this as an opportunity to get into everything when it's not crazy overpriced, into stuff that is going to change the world over the next coming decades, and things are going to increase dramatically in price over the coming decades. So as I mentioned before, there's these incredibly talented macro guys. I don't understand the majority of the gobbledygook that they talk about, because it's very complex and kind of boring, but the majority of them say, okay, quantitative tightening can go on for up until this percentage rate, or quantitative tightening and interest rate rises can go up for this amount of time, but eventually there is a consensus, and the Fed isn't going to tell you that, but eventually they're going to have to pivot. Who knows when they're going to do it and how much suffering they're going to be able to inflict on Americans and on the world before they have to do the pivot. Like, they'll probably go as far as they can, but eventually they will have to pivot, and the giant Ponzi of money printing is going to have to start again. But as I've mentioned before, I think the better thing to do than focus so much on trying to time the market is to focus on what you're investing in. So the things that I think will outperform over the coming decades, and I'll go into these in a bit further detail, but certain cryptos, certain technology stocks, and perhaps something like a biotech or something like that, And it just so happens that all of these asset classes, or all of these categories or industries, are in huge, massive discounts right now. So make of that of what you will. So right now, everyone is kind of laughing at these industries. Like, Cathie Wood is getting absolutely humiliated on Twitter. Everyone is calling her an absolute buffoon, an idiot, and slagging her for writing that open letter to the Fed, begging them to lower interest rates again. Everyone's laughing at Bitcoin, JPEGs, NFTs, Metaverse. Everyone's laughing at that, and they probably laugh at more. But in my experience, when everyone is laughing at a certain investment and it's potentially a really good investment, that's usually somewhat of a bottomish signal. Like, for example, look at this. On March 24th, Bitcoin maxis had this Death of ETH clubhouse party where they were just slagging how poorly ETH had performed against Bitcoin. They were just laughing at how badly ETH had been performing against Bitcoin, because Bitcoin had started to take off. Michael Saylor was promoting Bitcoin, talking about Bitcoin a lot, and lots of people getting onboarded to Bitcoin, and they were like, Ethereum is doing so poorly against Bitcoin. Look at this. At that particular moment, one Ethereum was 0.02 Bitcoin. You see, at the 25th of March, and from there it went almost 5x against Bitcoin, and Bitcoin was going up a lot, so it went 5x higher than Bitcoin from that point. So when something is getting mocked and laughed at, maybe it's time to start to counter trade, because that's when people are getting greedy. Like, the shorts are laughing at Cathie Wood. People who are shorting the market are laughing at her. That's kind of like that's a sign of euphoria and greed, because they're making a lot of money from the market going down, and they're laughing and having a great time, just like it was the inverse a couple of years ago. Right now, from what I'm seeing on Twitter, a lot of people are laughing at Bitcoin, saying it failed as an inflation hedge. Ethereum's going to overtake Bitcoin. Bitcoin's performing so poorly. Michael Saylor is an idiot. All this kind of stuff. So I'm actually kind of looking at Bitcoin again. Like, it could drop a little bit more down to 10, 15,000. Who knows where the exact bottom will be or when it will be. But at these kind of prices, like, you have to remember, Bitcoin is the gold standard in crypto. Like, countries aren't going to adopt Cumrocket. Companies aren't going to put Dogecoin on their balance sheet as an inflation hedge. Bitcoin is the most established for a reason. It's the safest. It is the most decentralized. It is the most neutral, and it gives you a ton of freedom and optionality, especially in a war potential times. It could actually perform quite well in a war, perhaps not initially, but when people need to transact, like Russia might need to use Bitcoin to sell oil and stuff like that. Bitcoin could have a real value there. The other thing I've talked about probably enough to you guys over the last few years is Tesla. Tesla's profits are going to be insane over the coming decades. They have massive pricing power, so they have the ability to raise prices along with inflation, and people will still pay for their cars because there is plenty of demand, and there will be huge demand for their cars over the next decade or so. So these are just a couple of examples of things that I think will outperform the S&P 500 over the next 10 years. And if you want to actually make returns, these are the kind of things you need to be thinking about. And yeah, they're the kind of the lower risk plays, but if you want to get into the kind of higher risk stuff like NFTs and metaverse, like I know that was a crazy hype like a year or two ago, but they're not dead. Like there was hype for a reason, just like in the .com bubble there was hype about .com stuff for a reason. Now a lot of those .com companies went to zero, but some of them did extraordinarily well. Like if we're looking at this chart that I mentioned at the start, you can see from the very bottom of the 2000 crash, like if you look at Amazon, went down like well over 90%, maybe 95%. But if you had bought Amazon when it was down 80% or down 70%, you'd be laughing today, you know what I mean? So fortunately it's not as easy as just, buying an index fund, not having to do any work, and making a really good return over time. Like that kind of time has been over for 20 years in reality, but it was kind of a scam the whole time anyway. If you want to actually make real wealth over time, you're gonna have to put a bit more work in, take a bit more risk potentially, and use your noggin a bit. Don't just take my word for it. If you don't believe in Bitcoin or Tesla, don't invest in them because I'm telling you to do that. You need to find your own convictions. You need to research Bitcoin by yourself or research Tesla by yourself and form an opinion for yourself whether these are actually good investments. Like I can give you my opinions on that, but I could well be wrong. But these are the bets that I'm taking anyway. They're kind of more risky play that you could think about. It's something I've done, but it's I wouldn't recommend it to 99.9% of people, definitely, and not financial advice whatsoever. But once QE starts going again, because they have to keep this Ponzi going, otherwise, like if the bond market collapses, all the pensions collapse, and there's huge problems through all the first world countries. So kind of their only option is to print money, and the biggest way, one of the ways rich people have gotten so much richer while the normal people or poor people have kind of stayed the same or haven't increased so much. The rich people obviously own all the assets, but at the same time, how are they funding those assets? How are they buying those assets? How are they funding their lifestyles? They're taking on debt, and the debt is being inflated away by the government printing money. So by the time they have to pay the debt is worth a lot less. So you could take advantage of this if you wanted, but do it in a very... I'm not telling you to do it. I'd say most people shouldn't, but it's something you might want to think about if you could get a low percent. It's something that I'm thinking about, not something you should think about. But if you can get a fixed low percentage interest rate to buy good hard assets that are going to increase in time, that's another way you can make better returns over the long term. You can kind of add a bit of fuel to the fire. But obviously, if I was to do that, I would need to make sure that I have consistent cash flow coming in every month to be able to pay off those interest amounts very easily, no matter what happens, and that what I'm investing in is going to at least keep up with the inflation or beat the interest rate that I've taken out on. Like if you're taking out something at 15%, or if I'm taking out something at 15% interest rate, you have to be kind of crazy. But if you're taking out something at a 5% interest rate and houses are going up by 10% a year, you're making a very nice return there, just because governments are forced to do this. So if you want to become rich or if you want to become wealthy, you need to kind of behave like the wealthy. So this is an option you can think about potentially, but it's obviously massive risk taking on debt. So not for everyone. You don't need to do that whatsoever. You can just sleep better at night if you're investing. If you can only lose 100% of your money rather than losing 150% of your money, for example. And just to add to that, in 10 years, like I said, if you had invested in the S&P 500 or you invested in a particular stock and it's done well over the last 10 years, but you'd have to pay a massive tax when you went to sell that, instead of selling it, the other thing wealthy people do, whether it's a house or whether it's stocks, you just borrow against that. Let's say your house that you've invested in, you now own it outright, instead of selling that house, that investment property, and paying 33% tax in Ireland anyway. What you do instead, you go to the bank, you say, oh, can I get this much, 50 grand, and against the value of my house. The value of your house isn't going to drop 90%, so you're safe, and it's basically just tax free taking out money, and then the value of your house goes up next year. The value of your house keeps going up every year, hopefully. Obviously it's not going to be perfectly going up, but then you just take out 60 grand the next year to pay off the 50 grand. You take out 70 grand the next year, and you can just keep taking out more and more money. As the value of your house goes up, the value of your debt stays the same. So look out for the things that will actually create tremendous value over the next 10 to 20 years, not just the things that are like, you can put some of your money into things that will just keep up with the money printing, but I think to actually make real returns in the stock market or within crypto, you need to like put a little bit more effort in on finding those things that will actually outperform. And I also just wanted to say thanks to everyone who's been commenting on my videos and been enjoying my videos. I really appreciate the kind comments, so that gives me a lot of encouragement to keep bringing these videos to you. So thanks very much. I hope you enjoyed, and I hope you learned something. Bye.